gold and silver did not crash because something broke. They crashed because something changed. In 2026, markets didn't react to inflation data, war headlines, or debt levels. They reacted to a signal, one that told capital the rules were about to shift. A single Federal Reserve appointment quietly rewrote expectations about control, discipline, and credibility. And once that message was understood, precious metals were no longer protection, they were excess. This is not a story about prices. It's a story about how power moves money before the public knows why. Every major market break begins long before prices move. It begins in the quiet space where expectations change, but headlines do not. For decades, gold and silver have been treated as timeless refuges, assets that sit outside politics, outside cycles, outside control. But history shows something far less comforting. Precious metals do not exist outside the system. They exist in reaction to it. And when the system signals a shift, metals are forced to respond, even when nothing appears broken on the surface. In late-stage economic cycles, markets stop asking what is happening and start asking who is in control. That distinction matters, because inflation alone does not drive gold. Debt alone does not lift silver. What moves capital is confidence, not confidence in growth, but confidence in authority. When that authority looks weak, metals rise. When it looks disciplined, metals hesitate. By the time 2026 approached, gold and silver were no longer misunderstood assets. They were consensus positions. Funds, institutions, and retail investors alike held them not as long-term insurance, but as near-term protection. And that subtle shift from hedge to expectation is where danger always enters. Markets punish certainty. When too many participants agree on what must happen next, price stops reflecting protection and starts reflecting complacency. Gold did not rise quietly into 2026. It rose loudly, publicly, and with moral confidence. That is never sustainable. This is the part most investors miss. Crashes don't require bad news. They require overcrowded belief. And once belief becomes crowded, all it takes is a single signal to reverse it. That signal did not arrive as a crisis. It arrived as a message. And from that moment forward, the outcome was already written, even though almost no one was reading it yet. The message did not come wrapped in policy. It came wrapped in intent. Markets are trained to listen not to what institutions say, but to who is placed in position to act. Long before any rate decision, balance sheet adjustment, or public justification, capital reads personnel as destiny. In late-cycle systems, appointments matter more than announcements, because they reveal the direction authority intends to take when the room goes quiet. By 2026, the Federal Reserve was no longer judged on inflation control alone. It was judged on credibility restoration. Years of emergency measures, narrative pivots, and political accommodation had eroded the idea that monetary policy was disciplined. Markets had adapted to that weakness. Gold and silver thrived inside it. They were not just hedges, they were expressions of doubt. Then the signal arrived. The selection of Kevin Warsh was interpreted not as continuity, but as correction. Not expansion, but restraint. Not accommodation, but structure. Warsh's history inside the Federal Reserve, his post-crisis criticism, and his alignment with institutional order carried meaning far beyond ideology. To capital, this was not about politics. It was about boundaries, and boundaries change behavior instantly. The moment markets recalibrated expectations around discipline, the narrative holding precious metals together began to weaken. Because gold does not rise on inflation alone. It rises when inflation appears unmanaged. Silver does not climb on scarcity alone. It climbs when systems appear unstable. What Warsh represented was not immediate tightening. It was future credibility. And future credibility is lethal to trades built on disorder. This is where most observers misunderstand the sequence. They look for action first, reaction second. But markets invert that order. Reaction comes first. Action arrives later, if at all. By the time any policy was discussed publicly, Capital had already moved. Gold was no longer being accumulated quietly. It was being evaluated aggressively. And evaluation is where selling begins. Institutional money does not panic. It reclassifies. When an asset's purpose changes, even slightly reallocation follows. In 2026, gold and silver were quietly reassigned from defensive necessity to optional exposure. That reclassification alone was enough to trigger pressure. No crash headline required. No emergency meeting needed. Silver felt it first because silver always does. Its dual identity, monetary and industrial, makes it hypersensitive to shifts in policy credibility. As expectations of restored control grew, industrial assumptions tightened, leverage unwound, and liquidity became a liability instead of a feature. Gold followed not because it failed, but because it was next in line. This is the uncomfortable truth history keeps repeating. Precious metals fall not when systems collapse, but when systems appear capable of enforcing order again, even temporarily, even symbolically. Especially symbolically. The appointment didn't change the economy overnight, but it changed how the future was priced. And once the future is repriced, the present has no defense. Once the future was repriced, the present began to fracture quietly. Markets did not wait for confirmation because confirmation is a luxury late-cycle systems never receive. By the time authority attempts to prove itself, capital has already decided whether to believe. In 2026, belief shifted before evidence existed. That is always the most dangerous phase when perception outruns reality. Under Donald Trump, markets had learned a difficult lesson during earlier cycles. Personnel is policy in slow motion. Announcements can be reversed. Rhetoric can be softened. But appointments reveal intent that cannot be easily walked back. This is why capital responds to them with disproportionate force. It understands that people shape institutions long before institutions shape outcomes. What followed was not a collapse, but something more surgical. Large holders did not exit gold and silver all at once. They trimmed, they hedged, they rotated. This phase never shows up in headlines because it lacks drama, but it is precisely here that momentum quietly dies. Volume thins, buyers hesitate, sellers grow patient, and patience, not panic, is what drains strength from any market. As this unfolded, a subtle contradiction emerged. Economic data remained unstable. Debt levels were still historically extreme. Geopolitical risk had not vanished. By traditional logic, gold and silver should have remained supported. But markets do not trade logic. They trade hierarchy. And the hierarchy had changed. For the first time in years, capital began treating institutional control as more credible than systemic fragility. That inversion matters. When belief shifts toward order even temporarily, assets designed to hedge chaos lose urgency. They are not rejected. They are deprioritized. And deprioritization is enough. This is where leverage becomes fatal. Much of the precious metals market had become layered with expectations built on continuation. Futures positioning, ETF inflows, and derivative exposure all assumed that instability would compound, not pause. When the signal suggested a pause, not resolution, just restraint, those structures began to strain. Margin requirements rose. Volatility widened. Weak conviction revealed itself. Silver cracked under that pressure first. It always does when narratives shift faster than fundamentals. Its price does not collapse because demand disappears, but because certainty does. And certainty had been carrying too much weight. Gold followed not as a victim, but as a consequence. As institutional portfolios adjusted to a world where credibility might return even briefly, gold's role became conditional instead of absolute. That single shift changed everything. When protection becomes conditional, it competes. And competition is unforgiving in late cycles. This is the phase retail investors rarely recognize until it's over. They see prices soften and assume opportunity. Institutions see prices soften and reassess premise. Those are not the same act. One is hope. The other is calculation. By the time analysts began arguing whether the move was temporary or structural, the market had already answered the question in silence. Liquidity was thinning, volatility was rising, and belief, the only thing holding the trade together, was no longer unanimous. The crash had not arrived yet, but the foundation had already shifted. And once foundations move, timing becomes irrelevant. When foundations shift, markets don't collapse immediately. They recalibrate, and recalibration is where the damage compounds invisibly. By this stage, the gold and silver markets were no longer driven by belief or fear, but by mechanics. This is the phase where narratives stop mattering and structure takes over. Liquidity, margin, collateral, and positioning begin to dictate outcomes that no individual participant can control. Once a market enters this zone, intent becomes irrelevant. The repricing of the future had already weakened confidence. What followed was the exposure of fragility. As volatility expanded, risk models adjusted automatically. Funds that had accumulated metals as portfolio insurance were forced to reassess correlation assumptions. Gold was no longer behaving as a stabilizer, it was behaving as a variable. That distinction alone triggered internal constraints. Allocation limits tightened. Hedging costs rose. What had once been passive protection now required justification. Silver faced an even harsher reality. Because silver exists at the intersection of monetary narrative and industrial demand, it is uniquely vulnerable when expectations fracture. As policy credibility appeared to reassert itself, growth assumptions softened. Industrial forecasts were revised downward. At the same time, speculative leverage embedded in silver markets became increasingly unstable. This dual pressure created a feedback loop that no optimism could interrupt. Liquidity, once silver's advantage, became its weakness. Sell orders no longer found immediate depth. Bid-ask spreads widened. Price discovery grew erratic. In this environment, exits do not happen cleanly. They happen violently, even without panic. This is how crashes form without emotion, through structure breaking faster than belief can adapt. Gold's descent was slower, but more consequential. As institutional money rotated toward yield-bearing assets aligned with perceived policy discipline, gold's opportunity cost rose sharply. Real yields did not need to become attractive. They only needed to become credible. Once that threshold was crossed, gold's justification narrowed. Its role was no longer universal. It was situational. And situational assets are always repriced downward in late cycles. This is where many observers make a critical mistake. They assume selling reflects loss of faith in gold itself. It does not. It reflects loss of urgency. Gold was not being abandoned. It was being postponed. But postponement at scale looks indistinguishable from rejection on a chart. By now, the selling was no longer discretionary. It was systemic. Margin calls forced liquidation. Volatility targeting strategies reduced exposure automatically. Algorithmic systems responded not to headlines, but to instability itself. Each wave reinforced the next, and because the original catalyst was credibility rather than crisis, there was no natural floor of fear-driven buying. This is the most dangerous type of decline, not one driven by terror but by indifference. As prices fell, the narrative fractured further. Some argued the move was temporary. Others insisted it was manipulation. But markets do not care about explanation. They care about balance. And balance had already been lost. By the time the word crash began appearing in commentary, the outcome was no longer in question. The structure had already decided. All that remained was duration. Gold and silver were not collapsing because the world was stable. They were collapsing because the world appeared governable again, even if only briefly, even if only symbolically, and history is unforgiving to hedges that lose their urgency even for a moment. This is the moment history always repeats and always shocks those who refuse to study it. Every long cycle breakdown produces the same emotional response among holders of hard assets. Betrayal. Not by governments, not by markets, but by time itself. Because gold and silver are expected to protect against disorder, many assume they should rise the moment instability becomes visible. But history shows the opposite sequence. First comes disappointment, then comes durability. What unfolded in 2026 followed an old and uncomfortable pattern. In past monetary resets, precious metals have consistently fallen during the transition phase, the moment when control appears to return. Even temporarily, this occurred after major policy consolidations, regime shifts, and institutional restructurings across centuries. Metals do not front-run chaos indefinitely. They retreat when order reasserts its claim, even if that order is fragile. This is why the decline felt personal. Gold and silver holders were not reacting to price alone. They were reacting to a violation of narrative. For years, metals had symbolized resistance to mismanagement. They had absorbed distrust, fear, and skepticism. When prices fell despite unresolved debt, geopolitical strain, and monetary excess, confidence cracked not in the system, but in the hedge. That psychological fracture matters more than any technical level. Once belief fractures, time becomes an enemy. Long-term holders begin questioning their patience. New buyers hesitate. Speculators exit entirely. And institutions, already gone, do not return quickly. This creates a vacuum, not of value, but of conviction. This is the purge phase. History never allows protective assets to rise smoothly into the final act. It forces them to prove resilience by surviving abandonment first. The crash of 2026 was not punishment for holding gold and silver. It was the cost of overcrowding them too early. Markets demand sacrifice before validation. By now, the public conversation had inverted. Analysts who once praised metals began questioning their relevance. Commentators framed the decline as proof that the world had moved on. And that narrative, the dismissal narrative, is always the last step before stabilization. Because assets do not die when they fall. They die when no one cares. And gold and silver were not dying. They were being ignored. This is the phase that separates speculation from endurance. Those who entered metals as trade exited in frustration. Those who entered as insurance questioned timing. Only those who understood cycles recognized the silence for what it was: preparation. Every previous monetary regime change followed this rhythm. A rise fueled by fear, a fall driven by credibility, and then a long, quiet period where metals stopped being debated and started being forgotten. That forgetting is essential. Without it, accumulation cannot restart. Without it, conviction cannot rebuild. Without it, the next phase has no foundation. The crash of 2026 was not the end of gold and silver's role. It was the removal of those who expected protection without patience. And history has never made room for that expectation. Once abandonment sets in, markets enter their most deceptive phase: calm without clarity. After the crash, volatility did not explode further. It narrowed. Prices stopped falling sharply and began drifting, uneven and quiet. To casual observers, this looked like stabilization. To experienced capital, it looked like something far more decisive: disengagement. This is where the long-term outcome is sealed. Institutional investors do not rush back into assets that have just disappointed expectations. They wait for silence. They wait for boredom. They wait for the absence of narrative. In the aftermath of the 2026 crash, gold and silver lost something more important than price: they lost attention. That loss changed everything. Risk committees rewrote assumptions. Precious metals were no longer treated as urgent hedges, but as legacy exposures. Allocation models adjusted accordingly. Even small percentage reductions, when applied across global portfolios, exert enormous pressure. And because these adjustments happen slowly, they are rarely noticed until the effect becomes permanent. Meanwhile, capital found new alignment. Yield-bearing assets tied to perceived policy discipline began absorbing flows. Not because they were suddenly safe, but because they were predictable. Predictability is the currency institutions value most during transitional periods. Gold and silver, by contrast, had become symbols of a threat that appeared postponed. Postponement is deadly to hedges. This is where time begins working against belief. As months passed without validation, long-term holders faced an uncomfortable reality. Opportunity cost. Capital tied up in assets that neither protected nor appreciated began to feel stranded. That feeling does not produce panic selling. It produces resignation. Resignation is far more final. Silver's market felt this first. Industrial demand recovered unevenly, but monetary enthusiasm did not. Volumes thinned. Volatility compressed. Each attempt at recovery lacked conviction. This is how markets signal that a cycle has completed its cleansing. Not through collapse, but through indifference. Gold followed a similar path, but with deeper consequences. Because gold is held as a statement of distrust, its stagnation sent a powerful message. The system was no longer being actively questioned by capital. That did not mean the system was healthy. It meant it was tolerated. And tolerance, in monetary history, is enough to suppress protective assets for years. This is the phase most investors misinterpret. They look at unresolved debt, geopolitical strain, and structural imbalance and assume metals must soon respond. But markets do not price inevitability until timing becomes unavoidable. Until then, they price compliance. In 2026, compliance, even reluctant compliance, was enough. By now, the crash had accomplished its real objective. Excess leverage was gone. Speculative narratives were dismantled. Retail conviction was exhausted, and institutional frameworks had moved on. What remained was a quieter, thinner market, one no longer crowded, but also no longer urgent. This is how long cycles lock in, not with finality, but with drift. Gold and silver had not been disproven. They had been delayed. And delay, in economic history, is often longer than anyone expects, because it lasts exactly as long as authority appears intact. The moment that appearance fades again, the cycle resumes. But until then, the market waits. And waiting is where decades are decided. Waiting does not feel dangerous while it is happening. That is why it works. History shows that the most decisive economic outcomes are shaped not during crises, but during the quiet intervals that follow them. These are the periods when systems appear stable enough to be trusted, but fragile enough to require obedience. And obedience, once restored, suppresses resistance far more effectively than force ever could. By the time gold and silver entered prolonged stagnation, the system had already achieved what it needed. Not reform, not balance, but compliance. Capital had adjusted to a world where authority appeared capable of delay. Delay of reckoning. Delay of collapse. Delay of accountability. That illusion, even when widely doubted, is enough to neutralize protective behavior. People do not hedge against disasters they believe can be postponed indefinitely. This is the great miscalculation of late cycles. Debt did not shrink. Monetary excess did not reverse. Structural imbalances did not heal. They were simply deprioritized. And markets, always obedient to hierarchy, followed suit. Gold and silver remained present, but irrelevant. Available, but unnecessary. That condition is far more suppressive than open hostility. This is why long cycles do not end with explosions. They end with exhaustion. By now, a new generation of participants had entered markets with no emotional memory of instability. They had seen metals fail to respond when they were supposed to. They had learned the wrong lesson that protection is obsolete. History relies on this misunderstanding. It requires each cycle to forget the last. Meanwhile, institutions grew more confident not because the system was sound, but because resistance had thinned. Capital flowed where permission was implied. Yield, alignment, predictability. These are not signs of health. They are signs of control, and control always precedes rupture. The quiet years after 2026 were not a recovery. They were compression. Pressure accumulated slowly, invisibly, beneath an appearance of order. Gold and silver did not warn loudly during this time. They waited. Because assets designed for rupture do not announce themselves during calm. They survive it. This is the part history never advertises. Those who abandoned metals during disappointment believed the story was over. Those who stayed, but expected immediate validation, grew bitter. Only those who understood cycles recognized the silence as necessary. Protection that never disappoints is never tested. And protection that is never tested never survives the moment it is finally needed. The crash of 2026 did not disprove gold and silver. It positioned them, not for headlines, not for speculation, but for the next phase, one that only becomes visible after obedience decays again. Because authority always fades faster than debt. Control always weakens before consequence. And when that reversal begins, markets will not debate relevance. They will scramble for it. And those who mistook delay for defeat will realize, far too late, that history was never finished, only waiting for patience to run out. History never rewards certainty. It rewards patience. Gold and silver did not collapse because they lost their purpose. They collapsed because they revealed it too early. Every long cycle demands disbelief before it allows validation. Every protective asset must survive abandonment before it is needed again. And every system insists on obedience before it accepts consequence. The crash of 2026 was not a failure of metals. It was a test of understanding. Those who expected protection without delay left. Those who mistook silence for defeat moved on. And those who recognized the pattern simply waited. Because history does not move on headlines. It moves on cycles. And cycles do not end when people are afraid. They end when people are convinced nothing can happen anymore. That is when protection matters again.